Okay, let's dive right into this. Welcome back to The Explainer. Today, we're opening the dossier on a truly high-stakes case in the market, Zoetis. Now, you probably know them as the world's largest animal health company. They are an absolute titan in pharmaceuticals for both pets and livestock. But recently, this absolute giant has been behaving more like a penny stock in a panic. And we're going to look at the hard data today to figure out exactly why.
$73.79. Just think about that number for a second. That is the current share price of Zoetis, and it's sitting at a massive 50% drawdown from its 52-week high of over $160. Why has this $30 billion giant, a company that essentially has a near monopoly in certain veterinary markets, suddenly lost half of its total value? Is the business fundamentally broken? Or is the market just throwing the baby out with the bathwater? Well, that's exactly what we're here to solve.
Act 1. The Valuation Gauntlet.
To get to the baseline facts of this trial, we ran Zoetis through the ultimate valuation gauntlet. We tested it across 21 entirely different financial models, just to strip away all the emotion and see what this stock is purely mathematically worth. We broke it down into 5 buckets. Group A looked at cash flow models, like your standard DCF, which priced it somewhere between $82 and $120. Group B looked at dividend and income models. Group C analyzed comparables, plotting it against peers, where it usually trades at a pretty healthy premium. Group D was definitely the harshest. Those are the balance sheet models looking at raw asset value and liquidation scenarios. Naturally, those came in a bit lower since Zoetis is a highly intangible, patent-heavy business. And finally, Group E factored in real options, which essentially values their R&D pipeline for new vaccines and therapeutics. Now, I know that is a vast sea of data, ranging all the way from a $12 fire sale liquidation to a $135 optimistic pipeline scenario. But when we actually aggregate all of this data, a really clear consensus emerges.
So the crucial point is right here. When you synthesize all 21 of those models, the average intrinsic value for Zoetis lands firmly between $82 and $105 per share. You're looking at a blended fair value of around $90 to $95. And remember, it's currently trading at roughly $73. That means purely based on the math, Zoetis is trading at a 15 to 30% discount to its intrinsic value. Most of these models are literally screaming that this stock is undeniably undervalued.
Act 2. The Conflicting Evidence.
But wait, there's always a catch, right? If the math is so overwhelmingly positive, why on earth is the market punishing the stock? Well, the market isn't entirely crazy. Let's call the prosecution to the stand and look at the deep red flags the market is currently terrified of, because these are serious. First up, revenue growth is decelerating sharply. We went from 6% organic growth down to flat, and they even posted a 1% decline recently. Second, there is some real weakness in the U.S. companion animal segment. Revenue decreased 7% in a recent quarter, and that is a big deal because that's their high-margin growth engine. Third, free cash flow conversion is weakening. It dropped from nearly 25% down to 24.12%. And fourth, and this is a big one that the financial media often glazes right over, total debt ballooned 37% in just 1 year, surging from $6.7 billion to $9.26 billion. That brings their debt to equity to almost 300%.
Continuing with the prosecution's case, we have flag number 5, rising days sales outstanding, or DSO. Put simply, it is taking them longer to actually collect cash from their customers, which is your classic warning sign of deteriorating receivables. Sixth, there's a lurking goodwill impairment. Because the market cap literally halved from nearly $65 billion down to $30 billion, the premium they paid for past acquisitions, which is recorded as goodwill, might have to be written down. That is a massive non-cash hit just waiting in the wings. And finally, management has repeatedly cut their 2026 guidance. Twice in just 6 months, they've lowered expectations.
So clearly the prosecution has a very strong case here, but the defense has a fascinating counter-argument. And this brilliantly illustrates why contrarian investors absolutely love scenarios like this. Let's look at the overlooked green flags that panic sellers are completely missing. Number 1, management is executing massive buybacks. We're talking over $1.1 billion scooped up at a 50% discount. They clearly know the stock is cheap. Number 2, they maintain a phenomenal return on invested capital of over 25%. Number 3, their operating margin is elite, hovering right over 40%. Even among the top pharma peers, that is a fortress-like margin. And number 4, they have over $221 million in unrecognized tax benefits, acting as a protective shield against future tax bills.
Let's finish up the defense's case. Flag 5. The stock has a low beta of 0.73. That means it's significantly less volatile than the broader market, offering some real defensive characteristics for a portfolio. Flag 6. The price-to-earnings ratio has compressed all the way down to 12x. For context, the pharma industry averages around 15.1x, so you're getting an elite company for a totally below-average price tag. And finally, insider buying. And we aren't just talking about executives exercising options. Independent directors are using their own hard-earned cash to buy shares at these depressed prices. They clearly smell a massive, overlooked opportunity.
When you put the two narratives side by side, the disconnect is honestly jarring. The media narrative is entirely focused on the scary headlines, growth slowdown, and guidance cuts. Because let's face it, that's what drives clicks. But the business reality sitting quietly underneath all of that noise is a company trading at a 12x PE, pulling in margins over 40%, and generating elite returns on invested capital above 25%. This right here, this massive gap between the fearful headline narrative and the highly profitable business reality is exactly where value investors hunt for those generational returns.
Act 3. The legendary investor test.
So we have the models, we have the flags, but how would the greatest minds in finance actually judge this specific set of data? We ran Zoetis through the precise historical frameworks of 3 legendary investors, and the verdict is a deeply divided 2-to-1 split. Ben Graham, the godfather of value investing, says no. His framework heavily favors tangible assets, and since Zoetis is super asset light and patent heavy, its current price of $73 is way above Graham's calculated fair value of $32.88. Peter Lynch, the absolute master of growth at a reasonable price, also says no. Lynch looks at the PEG ratio, price to earnings divided by growth. Because Zoetis' growth has slowed to the mid-single digits, its PEG ratio is just too high for Lynch's taste, so it fails his test. But Warren Buffett? Well, Buffett says a resounding yes. Now, what's really interesting about this is exactly why Buffett's framework triggers a strong buy signal here. Buffett is always looking for a fat pitch, and Zoetis serves one up beautifully. His framework heavily focuses on owner's earnings. Right now, Zoetis is generating an owner's earnings yield of roughly 8.5%. Compare that to a 10-year treasury sitting around 4%, and you are getting a massive equity risk premium. Combine that 8.5% yield with a 25% ROIC, a wide economic moat, and a management team that is aggressively buying back stock, and this looks exactly like the kind of high-quality, temporarily beaten-down franchise Buffett absolutely loves to acquire. Act 4. Moat and final verdict.
All right, so we arrive at our closing arguments. We've seen the valuation gauntlet, we've weighed the red flags against the green, and we've heard from the legends. The final piece of the puzzle, to determine if this business will survive its current stumbles, is evaluating the protective economic barrier, the moat around the company. According to Morningstar's framework, Zoetis possesses a wide moat, and incredibly, it is supported by all 5 possible sources. They have intangibles, with over 1,200 patents and massive brand equity. They have switching costs, because veterinarians really don't like changing reliable treatments. They benefit from a network effect through their global data. They have a massive cost advantage simply by being the world's largest animal health firm. And finally, efficient scale, operating in a tight oligopoly. However, and we absolutely must be clear here, the data suggests this moat is slightly shrinking over the next 3 years. Aggressive competition from rivals like Elanco, emerging biosimilars, and that U.S. companion animal weakness we talked about pose very real threats. The moat is wide, for sure, but it is currently under siege.
And that brings us to the ultimate tension of this entire explainer. You have world-class financials, an elite 40% margin, and a deep discount to intrinsic value on one side, but pitted directly against that, you have slowing organic growth, rising debt, and a management team that just keeps cutting guidance. The quantitative models point firmly to buy, but the short-term operational trends are literally screaming, wait. So, we leave the final verdict up to you, the jury. Is Zoetis a value trap disguised as a bargain, where the debt and slowing growth will eventually just crack the foundation? Or is this a classic Buffett-style generational buying opportunity to own a wide moat, world-class franchise at a 50% discount? You have the data, you have the models, and you've seen the conflicting flags. Now it's time to do your own homework. Drop into the comments below and let me know exactly which side of the fence you land on. Hey, if you found this breakdown helpful, make sure to hit that like button and subscribe so we can keep bringing you these deep dives. Thanks for joining me on this explainer. Keep following the data, and I'll see you in the next one.